So I just read Becoming Your Own Banker by R. Nelson Nash. It's a very interesting concept. The whole book is basically just explaining this one concept and how it can work for you. So what it is instead of using a bank every time you want to take out a loan or deposit your money somewhere, so instead of like unnecessarily a savings account, you would use this system. And this system is you save your money, you put away money every month, and hopefully in a way that'll get you interest that will compound on itself every month. And what you do is when you need that money for something, you take it out of your savings, but instead of draining your savings down to zero or 20% of what it was, you are loaning it to yourself like a banker would do. And so you're saying, okay, I can borrow this money, but I need to pay myself back at a rate of, say, 10%, or you could go with whatever rate that it would be for the loan that you want. So, for example, if you have $100,000 in there, you take out $50,000 as the down payment for a piece of real estate, and you don't just take that money out of your savings because that is your bank. Like, that's your personal bank, so you have to pay that money back with interest. The only difference is you are the one getting the interest instead of the bank. And you could still use a bank. Like I said, this is just the down payment. It's sort of like PMI in this instance, but you could use it for the entire financing of the purchase. You could use it for small things like vehicles. Even says you could use it for a vacation. But the thing is, you're loaning it to yourself, and so you have to pay it back. Now, here's where it gets really interesting. And this is what I've been doing a lot of research on, and I'm not yet positive that it's the best way to go, but so far it seems like it. The reason I'm not yet positive is because it does seem pretty crazy at first, and it seems pretty scammy at first. But you have to understand that first I explained the concept as you would do it through a savings account, and now I'm going to explain it how you do it in a way that makes it work much, much better. And I've watched a lot of videos on this, and I'm trying to learn as much as I can, but all the videos say they have a disclaimer. So I have to say that I'm not a financial advisor. This is not financial advice or legal advice, anything like that. So what they say to do is you do this through a life insurance policy. So you get a life insurance policy. The younger you are, the cheaper it is. And so you want to do this as soon as possible. What you do is you get a low death benefit. So instead of getting, $2 million when you die, you want to keep it very small. So it'll be $250,000, or if you're able to, $100,000 or even less. And what you're doing is you're using that as your savings. So you want to commit to an amount. So say $200 a month or $500 a month that you're going to be saving. Now what you do is you deposit that every month and you overfund the account. This will take a little while to put into action because they have to have enough of a security for them to want to keep providing the service to you, which is that coverage. So this can take a couple of years to set up and have fully working, but it can work a little bit before then. So you're paying in this $200 a month, or whatever it is, every month, and you're hopefully overfunding by some amount. Now, the thing is, you can take a loan from your insurance company based on the amount that you have in your plan, and especially based on the amount that is overfunded. So what you do is, let's say you want to buy that house now and you need the money for the down payment. You're going to go into your personal bank, which happens to be this insurance company. The money that you have overfunded, that earns interest. And that varies. It'll be somewhere around the 4 to 6% APY range. So you're earning 4 to 6% on this money, and it's compounding. Now here's the amazing part. This money that's compounding, you can give yourself a loan, which takes it out of the whole pool of insurance. So it's not coming out of your money. That insurance company You don't have to get verified for this at all. There's no credit check. You have the money. That's what it's based on. So they have to give you a check. And it takes like 1 day or something like that. So they give you this money that you requested for the down payment. Let's say you have at the time $20,000 in the account and you took out $10,000 just to keep it simple. So you will still earn interest at that rate of 46% on the entire $20,000, even if you've taken $10,000 out for the down payment. Now, because you're using this as a bank, you are going to pay back that $10,000, and you're probably going to pay back interest up to, $11,000. But that $20,000 total that you have right now, $10,000 you have as a loan, you're still earning interest on the entire $20,000, and your loan is costing you about 2% per year interest. So essentially, if you're making, let's say, 4% on the low end, and you usually do this through a mutual company where you're a partial owner of the company based on your investment into that policy. So that gives you a dividend, which is usually like 2 to 3%. But let's just base it on the 4% for now. So you're earning 4% per year on the $20,000. Let's go even crazier. Let's say you take the entire $20,000 out as a check. But that check is a loan that you're paying at 2%, and your actual money is still there, earning interest at 4%. So essentially you have money that you've put in there, and then you took it right back out. Not right back out, but that's the general concept. And then you're earning 2% per year, compounding, uninterrupted compounding, and no chance of loss unless the entire insurance company goes under, which you do this with insurance companies that have been around for literally hundreds of years. Most of them have been around for 200 years. Great Recession, Great Depression, no problem. They've gone through it all with no issues. So you are using their money and giving them your money. You break even. You basically have not invested anything aside from a little bit for your policy. And you're earning 2% compounding uninterrupted until you die. So basically forever, you're earning 2% on money that you gave them and took right back. So 2% on nothing, 2% on pretty much your net worth for nothing at all. Like, that's pretty amazing. So the way that they make money is they get you to make payments over time, and they invest those, and then those compound. So if you invest, or if you pay for your policy of $100,000, if you pay $100 a month, starting from when you're like 19, through that compounding interest, they can figure out how much money they will have when you die, approximately based on averages. So they're making money in that way, and that's how you're basically paying it off. Like they have your policy. They have $250,000. If you die tomorrow, you get that $250,000, or, obviously your relatives or whoever you want to get that money. But while you're alive, you're earning 2% on the money that you're putting in every month, even if you're taking it out the next month. So that's the general concept of the book. It's an amazing strategy. I think it's definitely something that you can do with a savings account. It just requires discipline. But to really make it work, you need to do it through the life insurance account. And I don't know everything about this yet. I feel like I know a lot about it, but there's probably still a lot more to learn before I actually go through with this and do this. But I think that the strategy is amazing. It's called IBC. Some people call it a 770 plan. And basically, you want to make sure that it's a plan just for this, because it is a little different than a typical life insurance plan. And a couple more things to note is that this was basically how people saved their money before the stock market, before they started investing in 401ks and things like that. This was how they saved their money. People like Walt Disney, they say in the movie It's a Wonderful Life, the guy cashes in his life insurance policy. Obviously, that's how he was saving his money at the time, and he was, in finance, so that made sense at the time. And nowadays, people are like, life insurance, that you don't put money in there. Like, how could you, Because you think, like, your car insurance, no one saves money in their car insurance plan, but life insurance can be structured differently, according to this book. And he has actually written 2 more books, which I hope to read very soon. So definitely check out this book and look into this system. I'll definitely make a follow-up video as well if I end up going through with it and getting the life insurance plan in order to try this out. But in order to cover all of the premiums and everything, it'll probably take like 3 to 5 years to take effect. I think because my age is much younger than the examples I've seen, it could potentially be less. But overall, it could grow to a large amount to where you're taking out $1 million to buy real estate, and then that $1 million is still compounding as you're making more from the real estate. You could even invest it in stocks while it's still making money over there. The point he really emphasizes is it may not be the best return, it may not be the best investment, but it's not an or investment. It is an and investment. So you could do this and whatever else it was you want to do. You don't have to do this instead of whatever else you were planning on doing.